Hello and good afternoon. Thank you for being on our webinar today. I appreciate your time and willingness to learn about this wealth building strategy. My name is Veronica Saldivar, and we also have Karin Hall of UDirect IRA with us as our expert guest. To get us started, I'll share a brief outline of our webinar today and also share what you can expect from both of us. You have already made the first and most valuable investment, which is your time, so let's be sure to maximize it. On this webinar, you can expect to learn some basics about commercial real estate investing, factors I use to help identify strong investment markets, and how I select a project to invest. Karin will explain how you can use your retirement account to invest in commercial real estate. But first, let me share who I am and why I do this. I grew up in Southern California and have lived here for most of my life, aside from 4 months I lived in Argentina and a year that I spent at flight school in Arizona. At the age of 18 years old, I started flight training at John Wayne Airport. After my first flight, I knew what I wanted to be when I grew up, and I was going to be an airline pilot. A few months after my 19th birthday, I had my pilot's license, and I'm often asked, does anyone else in your family fly? The answer is no. I just thought it would be a cool thing to try. While attending Cal State Fullerton, I worked as a teacher's aide. After I graduated, I went on to be an elementary school teacher and taught kindergarten and 3rd grade. It was a great fit for me. I loved teaching, and I had afternoons free to study and continue my flight training. So I had completed my commercial pilot and certified flight instructors soon after. After about 3 years as a teacher, it was time for me to pursue my dream as an airline pilot. I resigned to become a full-time flight instructor at John Wayne Airport, and I absolutely loved it. It combined my two passions, teaching and flying. I had a smile on my face every morning as I drove to the airport. Soon I had about 1,500 hours of flight time, and I was officially eligible to apply for a pilot position with the airline. But something really made me hesitate. My friends at the airlines were telling me how horrible the work conditions had become, and in the process, I was in serious credit card debt, had student loans, and made less than $18,000 per year as a flight instructor. Well, one day while I was ready to get into my car and head to the airport, I ran into the owner of my apartment complex. The property manager introduced me to him, and I remember thinking to myself, I want to own apartments too. Well, something in my life had to change in order for me to get there. While I was ready to apply to the airlines, I realized I needed to make much more than $18,000 per year to pay off debt and to make a decent living. Some airlines were on a hiring freeze and had layoffs and reduced retirement benefits, and it really wasn't easy to advance the ranks and get pay increases. The industry had completely changed, so I decided to stop pursuing my airline career. And it honestly was a really low point in my life, as I had invested so much time and energy and money into something that I was walking away from. I had to ask myself 2 questions. At the major fork in the road, I had to make a decision about what to do next. In 2004, it was all the rage to become a mortgage broker or realtor, but I had a feeling that the good times and fast money wasn't going to be around very much longer. So I researched other opportunities that would have a stable and longer-term outlook. What am I going to do next was the question, and I decided to specialize in the financial services industry, focused on small to medium-sized businesses, helping them to cut costs. Soon I had mastered the business and was paying off my debt quickly, as I was back on my feet in no time. And after a couple of years, I decided I'm ready to start my own office. As I was building my business and becoming more financially secure, I had the freedom to pursue things I'm passionate about. And I also had time to look around and see what else I wanted to dive into besides aviation and building a business. So the next question I asked myself was, what's important to me? Well, I had plenty of time to spend with my family. I was able to take care of my 6 family members and fly to Texas to spend 3 weeks with my grandmother before she passed away. I didn't miss any football, soccer, basketball games, or dance recitals. And I also had time to give back both time and money. I've helped to raise funds for the American Cancer Society. I've donated funds to the Santa Ana School District for books and field trips. And I also helped to develop a sport program for a youth center in South Africa. I have funded outreach for at-risk youth, young adults in high school and juvenile detention facilities. And I've also volunteered my time with my church for both local and international projects. Giving back, teaching, and sharing my journey is something that motivates me, which is why I'm here now on this webinar. While I contributed to my community, I was growing my startup business into a multi-million-dollar enterprise. Upon the launch of my business, I had a very clear exit strategy. I would eventually sell it and perhaps build and sell another one. After a couple of years before the sale of my business, I was preparing for a major liquidity event, and I wanted to learn how to invest and actually find out where I would invest as well. So in 2010, I began to ask myself those questions, and by 2011, I had found the answer. The answer is apartment buildings. So why apartment buildings and why not single-family homes? After all of the methods and markets I researched, the answer was clear. It was definitely commercial real estate. Now, commercial real estate includes office space, hotels, public storage facilities, and but I'll focus today on multifamily investments. So we'll be discussing 8 reasons why it's a good time to invest in multifamily real estate. For number 1, it's definitely less competition. The average real estate investor will start in their own backyard purchasing single-family homes. They'll hold on to a home or rent or perhaps buy and sell it and purchase another one. The next step might be to purchase a duplex or triplex. But unfortunately, this business model is ultra-competitive. More recently, investors are competing with hedge funds, international investors, and all-cash purchases. There's a lot of competition. And if you apply the buy and hold or flip model to apartment buildings, there is less competition, and you can multiply your profits faster. The next reason is cash flow. Now, everyone in the real estate business wants to purchase properties that produce cash flow. Multifamily properties produce cash flow from day one and continue to increase cash flow year by year. Stability. When a single-family home is not rented, the owner is out the rent for that month or perhaps even several months. However, when one multifamily unit is not rented, the other units continue to pay so that you're earning a steady, stable cash flow. Next is less work. Once the property is closed, you have to set forth a plan of action, and there are weekly reports and monthly financials to review. But the work as far as the clogged toilets, the leaky roofs, the slow rent payments are all handled by professional property managers. You can enjoy a higher quality of life without the headaches of being a landlord. Economies of scale. With single-family homes, you have one rental unit with one roof. In a multifamily situation, there are many units under one roof, and so on and so forth. It's just cheaper and easier to own multifamily. Supplies can be purchased at bulk and wholesale costs, and many steep discounts are available. Now, one of my most important factors why I love multifamily is that you're not necessarily limited to owning in your own local region. Because you can use a property manager, the theory behind it is you buy where it makes most sense and where the returns are the highest. You can choose to live where you want, but by following the best markets in the nation during the best market cycles, you can increase your return on investment. You're also financed on the business income, and so there's inherently less risk. Now, multifamily property acquisitions are based on the income and performance of the property. Personal finances come into play only as a point of reference for the character of the purchaser and/or purchasing group. When buying multifamily real estate, the purchase is made on actual performing numbers at the time of purchase. Now, the last reason, and perhaps the most important factor, is market timing. We are in a huge growth cycle, and it's a great time to invest. Now, the U.S. marketplace is currently experiencing one of the largest growth cycles in multifamily history. The recent housing crisis and overall economic downturn created a huge slowdown in construction and development industries. The virtual standstill in construction, especially in housing, has caused the near impossibility to obtain financing as well. Now, likewise, these dramatic changes in credit markets have made it much more difficult for individuals to qualify for a mortgage. This lag in construction and tighter lending environment is expected to last for the next several years. Add to the equation the growing U.S. population and the coming of age of the echo boomers. Now, the echo boomers are the children of baby boomers, which are now estimated to be numbered well over 80 million. And they're just beginning to graduate from college. Now you have a recipe for demand in rental housing without an adequate supply of inventory. Now, so far we've identified the reasons why commercial multifamily is a strong investment platform. We've taken a look at why the timing is right. Now let's take a look at where I invest. As mentioned, we look for emerging markets. In simple terms, we search the entire nation and study many factors, but one of the most important is job growth. In fact, it is a fair statement to say we follow the jobs. Where are the areas of job growth now? Well, it's pretty simple. It's North Carolina, South Carolina, Georgia, Utah, and Texas, and these are examples of these emerging markets and where it's likely that I'll be searching for investment properties. Multifamily units operated in emerging markets tend to have higher occupancy rates because emerging markets tend to have more jobs. And while you have more jobs, that's where people need to go and find a place to live. It is a really simple formula. So the next question we'll talk about is how do I select a property? Well, purchase properties where I can increase the value by decreasing expenses and increasing revenues. And these are just a couple of the strategies that I use. Now, to give you a more in-depth example, let's go ahead and take a look at a case study. In our sample case study today, we're going to look at a complex that has slightly over 125 units. The approximate purchase price is $4 million, and it is in the Dallas metro area. Now, the owner has about 10 apartment complexes, but he's overextended and needed some cash to continue building his new project. This development project was stalled due to a lack of funds to continue. So, in other words, he needed to sell quickly and wasn't paying close attention to this project. After the completed analysis, this is what was found. The main strategy here is to increase rents. Now, the building had the lowest rents for both 1 and 2 bedrooms in the comparable marketplace. The 1 bedrooms were $75 below market average. Now, if you take 87 units and multiply that out by 12 months and then times that by $75, on this item alone, we are able to increase the annual income by $78,300. Likewise, the 2-bedroom, 2-bath units are also below market value. And as you can see here, the annual increase there is $17,052. Lastly, for the rent increases, the 2-bedroom, 1-bath were only $19 more than the 1-bedroom, 1-bath. And so this gave us an extra boost of income of $8,904. The next common strategy that you'll see in multifamily is to charge tenants for water usage. And it's a bill back is pretty common, and what we're able to do is to bill back 75% of the water bill, which is approximately $15 per month per person. And that item increases our annual revenue by $33,494. Now, again, because we were able to take advantage of economies of scale, we have staff management and maintenance staff and property managers already in the area, so that allowed us to reduce our payroll as well. Now, as you can see, when we total up all of these items, and if all of these strategy items are to be completed, the value of this property would increase by $2 million based on current market and property values. So once that those factors have been identified, the next thing that we take a look at is the seller. Now, is this seller motivated? Once I have identified the financial criteria makes sense, we look to see how able we are to negotiate a better price and to get perhaps a discount on the property. And here are several reasons why a seller might be ready to move fast, and it's because of retirement, illness, divorce. Oftentimes we also see burned out landlords, and in the case of that we looked at in our study, we had an overextended owner, and that sometimes is also a major factor on why we can get some deep discounts on our properties. Now remember, I started a quest for the best investment platform in 2010, and I began to invest in apartment buildings in 2011. In 2012, I sold my business and became a full-time investor. I wasn't comfortable with the traditional Wall Street type investments. I was looking for the best place to invest my money, and I wouldn't share anything I personally do not invest in. So I would just like to share a few properties in my portfolio. In the San Antonio area, there's a $14 million property. Atlanta, a $4 million property. In the Dallas area, $7 million property. And with the most recent acquisition, the total portfolio that I manage and co-own comes to 797 units valued at over $36 million. So the next question is, how do you invest? Now, most people cannot purchase a $4 million property on their own, and even if they could, I really wouldn't necessarily recommend it just because you have a lot of risk tied up into one property. Also, you're not likely to get financed because there's a lack of operational experience, and it will be tough to get financed. So we are currently looking for qualified investors to participate in our project. This investment strategy makes multifamily investing accessible to many people. Investors are a member in an LLC, and they own a percentage of the property. The minimum investment is $25,000 to $50,000, and yes, you can own a part of an apartment building as well. Now, there are two ways to invest funds. Number one, you can use your liquid capital, and number two, you can also use your retirement account. And as mentioned, we have Karen Hall as our retirement account expert, and she's here to help us learn about exactly how to do that. After 20 years of experience at Bank of America, IndyMac Bank, and her own mortgage brokerage experience, Karen Hall saw the recession take hold of the mortgage in market collapse. And rather than folding up her tent, she decided to go into a promising new direction of self-directed IRAs. Now Hall is a passionate educator and facilitator for better retirement through highly diversified controlled IRAs. And she shares her expertise with investors and advisors through speaking engagements. And now to help us educate us with this powerful wealth-building strategy is Karen.
Veronica, thank you so much. I appreciate it very much. Okay, so we'll talk about self-directed IRAs today and how you can use the power of your retirement account to invest outside the stock market into assets like Veronica has been talking about, things that, well, we like to say invest in what you know best, things like real estate, private stock, maybe it's going to be precious metals, maybe your IRA is going to lend money and make a note. So Veronica, if you want to hand the controls over to me, I will get going.
Okay, Karin, you should be the presenter right now. I'm not sure if you're showing that on your screen.
No, I'm not.
No?
I think there's a little blue badge in the upper right that says Change Presenter.
Okay, let me try to hit that again. How about now?
Yeah, you gotta love technology. That didn't come through.
Okay, let me try to do this stop screen from showing and then try to kick it to you.
Great. In the meantime, I'll mention that there we go. That what self-directed IRAs are all about is giving you the power of choosing what you're going to have your IRA invest in. I think I've got it over here, Veronica. Thank you so much. So here we go. And a little caveat here for the attorneys, so they'll be happy. We don't provide, what we do is we provide self-directed IRAs. What we don't do is give you tax and legal advice or investment advice. So if you want to know, hey, is this a good investment? What should I invest in? Those kinds of questions we don't answer. But when it comes to how do I self-direct my IRA, that's what we're here to answer for you. Of course, IRAs are all about saving for retirement. So when you're using a self-directed IRA, the question to ask yourself is what I'm doing, am I using this to invest? Is this an investment? Is this an investment for retirement purposes only? And if the answer is yes, you can pretty much do it in a self-directed IRA. You know, there's a huge deficit, as you probably are well aware, but there's a big deficit between what Americans have and what we actually need to retire. The idea that someone is going to be there to take care of you is probably not true, so we have to really get on the ball and start saving for our retirements, and self-directed IRAs can really help you do that. For example, if you had $100,000 in a retirement account, which is about the average size of one of our accounts, and you wanted to, say for example, retire, you're 59 and a half and you know you're going to live until you're 86 and a half, so you're going to take even distributions every month, assuming no growth or loss. That means you're only going to have just under $400 a month out of that $100,000. So what that says is that you need to probably save more than that, and you need it to grow so that you have money that sustains you through retirement. Since we live longer, I mean, the further, you know, the more years go by, the longer we live. So definitely save for retirement. That is a big thing, and self-directed IRAs are a tool for that purpose. When it comes to retirement funds, there's something like, well, it's over $23 trillion in America in retirement funds. It sounds like a lot, but there are a lot of us. So of the total pool of funds set aside for retirement, only about 3 or 4% of it is in what's called alternative assets, and that means not the stock market. So there you go. So if you are looking to raise capital, IRAs are a great source of doing that. If you haven't heard about self-directed IRAs, you're not alone, I have to say. I talked to someone on the phone today who was saying that it's the first time they heard about it, but you know what? You've been able to self-direct your IRA for 40 years. The ERISA laws were signed into effect by Gerald Ford in 1974, and they went to effect in 1975. So this year, it's 40 years that you've been able to self-direct an IRA. It's nothing new. We've all been around the block with the IRS on this, so just know that you're not doing something that has no track record. Self-directed IRAs are well known. So what's the difference? People will look at the website from time to time and they say, hey, Karin, I'm on your website. I'm looking here at the IRAs. Which one is the self-directed IRA? And the answer is an IRA is an IRA. There's the traditional, the Roth, the SEP, the simple, spousal, inherited IRAs. What makes it self-directed is the asset that IRA plan can invest in. So a typical IRA, whether, you know, again, traditional Roth, SEP, simple, inherited, spousal IRA, if it's typical, it can only invest in the stock market. Stocks, bonds, mutual funds, CDs, and that sort of thing. And then that's what you're limited to. But a truly self-directed IRA can invest outside the stock market in things like, well, the rental property, like Veronica was telling us about. Your IRA can be the bank, make notes, maybe deeds of trust, that kind of thing. Invest in private stock. Maybe, you know, someone's starting up a company and you want to take your IRA and help them with startup capital. So many different things your IRA can invest in. So just know that an IRA is an IRA. What makes it self-directed is the asset that plan can invest in. So what about losses? I think that this is a really good time to talk about due diligence. Because when you do invest your self-directed IRA money, you are investing precious dollars that were put away for retirement, but you've got contribution limits, so you can only put away so much, right? So you want to be very careful and do your homework up front, do your due diligence. Because say, for example, your IRA invests in a company and the company goes belly up, not only did the company go belly up, but then you have to prove to the IRS that your asset is worthless. So you have to then obtain a valuation. So you can't just give us a stated value if there's a zero value in your account. You have to provide a valuation. These losses can't be written off, and they're definitely not easily replaced in the IRA because of contribution limits. So the best way to make a good investment is to do your homework. Google the people who you're investing with, Google the principals, look them up, research them. On the UDirect IRA Services website on the right-hand column is a list of different agencies that will help you with this kind of due diligence for your investment. So do your homework up front. What are the limits? Well, a self-directed IRA can invest in anything except life insurance policies and collectibles. It's funny that the IRS, they don't tell us what we can do, they just tell us what we can't do, and here it is, life insurance contracts and collectibles. So that's pretty much it. No antique cars in your IRA, no fine wine collection. That's not going to happen. So what if your funds are with your current employer? I had a couple calls about that this morning where the two people had left their employer and they were wanting to invest those funds. They shouldn't have a problem at all. But if you're still at the company that employs you, at the company that provides your retirement account, you will probably not be able to move those funds and self-direct them until you leave the company. However, you can go to the plan administrator and say, hey, I'd like an in-service transfer. What that means is you're working there, you're in service, but you'd like to move your money. So they will tell you whether or not an in-service transfer is part of their plan document. So it may be possible, but more than likely you have to leave the company before you can use your 401k dollars, or maybe it's a 457, or maybe it's a 403b, or some sort of employer plan, just so you know. With self-directed IRAs, it's important to know the rules. I have to say that because you really want to have the right expectations when you're self-directing your IRA. It's not the same as investing your cash. And the rules are not intuitive. You may not have ever heard of them before, and they might even surprise you. So that's really one of the takeaways from this webinar, that I hope you walk away saying, hey, now I know that if I'm going to invest my IRA, I have to watch out for certain things. So some of the rules about IRAs are written on the IRS's website, irs.gov, publication 590. You can look it up. It talks about, because remember, an IRA is an IRA, whether it's self-directed or not doesn't change the rules about how IRAs are run. So one of the things is you're not going to borrow any money from an IRA. You can borrow money from a 401k, that's different, but you don't borrow money from an IRA. You're not going to sell any asset that you already own to your account, your IRA account. You don't use the IRA as security for a loan, and you're not going to use it to buy property for personal use, either present or future. So those are some of the rules. The other rules are covered in the Internal Revenue Code 4975, where it discusses qualified and disqualified persons, okay, people who are allowed and disallowed. Disqualified persons are your lineal ascendants and descendants, your parents and grandparents and their spouses, you and your spouse. Your children and your grandchildren and their spouses are disallowed to your IRA. Also, anybody who offers services to the plan is a disqualified or disallowed person. But the people who are allowed are the people out to the sides on your family tree, like your brothers and sisters, maybe your aunts and uncles, your cousins, that sort of thing. So first off, when you go to invest your IRA, are the parties to the deal allowed or disallowed? That's one question you want to ask yourself. Make sure that, because we want to help you avoid this, the prohibited transaction. You can think of the self-directed IRA as a game of keep away, and it's a keep away from this. If you commit a prohibited transaction, it's not good, because the IRS could disperse your entire IRA to you as a taxable event with penalties and so forth. So you don't want that to happen. We don't want that to happen for you. So let's talk about the rules. Prohibited transactions fall basically into three buckets. Number one, neither you nor any of those disqualified people can benefit from the IRA today. I'll have people say, hey, I want to take my IRA and invest in my business. Well, if you've got your IRA money, it invests in your business that you run, and you draw a salary, you're receiving personal benefit today from your IRA dollars, it's a prohibited transaction. For your IRA would not invest in a company that your spouse is starting either, because your spouse is a disqualified person. They can't benefit from your IRA today either. An IRA is for retirement purposes only and investment purposes only. Stay away from disallowed people. Number two, your IRA is not going to buy, sell, or exchange property between the plan and one of those disallowed people. So your IRA doesn't buy any property you currently own. Your IRA doesn't sell property to, for example, your kids or to yourself. You're not going to buy an asset from your IRA. You would take it as a distribution. Now, of course, it says buy, sell, or exchange. It doesn't say transfer upon death. So if you pass away, your lineal ascendants and descendants, whoever you name as your beneficiaries, will receive your IRA. But while you're alive, you're not going to be, your IRA is not going to be doing business with the disallowed people. Number three, a disallowed person isn't going to provide or can't provide goods, services, or facilities to the plan. What that means is maybe your IRA is buying real estate. For example, your son can't be the listing agent. Okay, maybe your IRA has a rental property and the lawn needs to be mowed. You can't do that. They call that an over-contribution of sweat equity. You like that? So with a self-directed IRA, you want to keep everything arm's length. When your IRA owns real estate, what you can do is you can select the property, you can screen the tenants, you can pick up and collect the rent checks, you can hire third-party vendors, but you don't do any of the work yourself, and you keep everything arm's length. You make sure that all proceeds of the IRA investments go back in the IRA that originated the investment. We had one time somebody had their self-directed IRA invest in a rental property, but then she put the rent in a different IRA, which is not allowed. It has to go back into this self-directed IRA. Also, any expenses of the IRA must be paid for by the IRA. So if you're, not all assets have expenses, but if you're buying, for example, a rental property, maybe you've got property taxes or repairs, that sort of thing, the IRA must pay all those expenses. Okay, so back to the idea of setting your expectation about a self-directed IRA, understand that there are different parties involved. It's not just like investing with cash at all. There are different rules. So there's you on the one hand, and then there's your IRA on the other hand. So when your IRA invests in a property, it's not you buying it, it's your IRA. It's a different entity. You don't sign that offer to purchase, for example. You don't sign that contract. We sign on behalf of the IRA. The other parties to the deal, you direct IRA services. And when I formed the company, I shopped for a custodian to hold our clients' funds, and I talked to a few banks and a couple different custodians to find someone to hold our clients' funds. And I created an agreement with a trust company custodian called American Estate and Trust out of Nevada. So these are the players in your self-directed IRA picture. You direct IRA services is your point of contact from beginning to end in your IRA. Every question that you have regarding your self-directed IRA, we can address for you here at UDirect, and that's what we do. We help people all day long. When you buy real estate with an IRA, pros and cons. This is another phone call I had today with a gentleman who's looking to buy some investment property. He says, hey, Karen, it sounds like a great idea, but what's the downside? So we'll cover that. The pros are that all the gains, capital gains if you want to call it that way, but any cash flow that goes back in the IRA sits there tax-free in a Roth or tax-deferred in a different kind of account. There's no time limit for holding property. You can buy it today, your IRA can buy it today and sell it tomorrow. That's just fine. The IRA can actually borrow money, and I'll talk about that. Whether or not you want to or not is a different thing, but it's possible. It's not you borrowing the money, it's the IRA borrowing the money. And there is also a potential to earn a larger rate of return on invested capital. You can compound your earnings faster because the earnings are not diminished by taxes. So you buy a property for X and you sell it for, a profit. The entire amount comes back in your IRA. The entire amount can go back out in your next deal. So you're going to compound faster. That money can keep working for you. The downside about buying real estate with your IRA in particular is that you don't get those deductions, those immediate write-offs of being a real estate owner. For example, if your IRA has a condominium in Hawaii and you think, oh, hey, I'm going to take a trip with a family out there and I'll write it off because my IRA owns a house out there. Well, you're not going to have those kinds of tax advantages if your IRA owns the property because you already get a tax advantage of your profits being tax deferred, right, or tax-free in a Roth. You're not going to take any deductions, capital losses or whatever. Of course, you, self-directed IRA, you are solely responsible for all the gains and the losses in your account because you are selecting the investment. You are the investment expert. You come to us, we're a neutral third party, you say, this is what I'm doing, move this through so my IRA can buy it, and we follow your instructions. That's why we're called U-Direct, because you direct us on what you'd like to invest. Now, of course, as I mentioned before, you're not going to replace losses in an IRA. It's going back to buying real estate with your IRA, the downside. If your IRA were to lose money, if a deal goes bad, those losses are limited to your contribution limits, which those vary based on your income and your account type and so forth. So I mentioned that an IRA can borrow money, and it can. Whether or not you want to is another thing, but your IRA can borrow money, and it's like a commercial loan. It's called a non-recourse loan that's made to the IRA. So basically what happens is if your IRA were to default on the loan, the lender can only come against the subject property, not against any other assets in the IRA, and not against you personally. So that's why it's non-recourse. Now, there are not a lot of lenders to choose from. I do have a short list that I've put together as a courtesy to our clients. If you'd like it, I'll be happy to send it to you. You can email me at khall, K-H-A-L-L, at the letter U, udirectira.com, and I'll send you the list. These non-recourse lenders are going to require a larger down payment typically. So again, it's not like regular investing. You're not going to go out there and get a Fannie, Freddie, FHA, VA loan, whatever, for an IRA-owned property, because of course you can't personally guarantee a loan to the IRA. And that's a really big point, because a personal guarantee to the IRA is a prohibited transaction. You're not allowed to do that. So you could have somebody who's not disqualified guarantee the loan, but you cannot guarantee a loan to your own IRA. Yeah, when your IRA borrows money, that can cause a taxable event to the IRA account. I was pretty surprised about this when I first heard about it, so I imagine you are too. Because wait a minute, aren't IRAs tax-free and tax-deferred? I mean, they really pretty much are, unless you do two things. One is borrow money, and the other one is run a business in your IRA. This is a conversation to have with your tax advisor. UDFI, unrelated debt financed income tax, is a tax on the income an IRA receives because of debt. And the other time an IRA can be taxed is if it's running a business. Now, sometimes fixing and flipping properties, that kind of active income, can be running a business. So you want to have that conversation with your tax advisor. You can go to the IRS website, look up Publication 598 and read about it. But just so that you are aware that there are these little, this small little minefield to navigate through so that you don't step in it. It's not that you can't do it. You can. It's just got the potential to be taxable. Okay, so how do you get assets, real estate or whatever, into a self-directed IRA? I like to say, first open a self-directed IRA. And that seems pretty obvious, like no kidding, but you have no idea how many people don't do that. They go out and find the asset first and say, hey, this weekend I was out looking for property and I found a property, it's great, now I want to put it in an IRA. And that's how people are, and that's what you're going to do. But be smart. Open the IRA first and fund it, because guess what? It's going to take your current custodian about 2 weeks to move the money from where it is into your self-directed IRA. If you find a property this weekend and you don't have a self-directed IRA, but you want your retirement funds to pay for that, you're going to have to wait until the money is moved over by your current custodian. So open the account first and get it funded, then shop for a property so that you're ready with that earnest money. You're ready to go. Remember, you don't sign the offer to purchase. We sign it on behalf of the IRA. So you give us a direction letter. You give us the contract. If it's an offer to purchase on real estate, if you're making a note, it's the note. If you're buying shares of a private company, it would be a subscription agreement. You give us those things. We review it. Fund, when it's a house, we wire funds usually to closing. You fund, you record, you get your keys, your tenants move in, and your tenants make their check payable to the IRA. There you go. Now, another thing they could do with real estate is your tenants could make their check payable to the property manager, who then keeps a small amount for repairs and sends the rest to the IRA. They just have to keep good books. So that's another possibility. So let's run through an example here. Here we have a father and a son, and they're going to buy a house together. But wait a minute, wait a second. Didn't I say that they're disallowed? Yeah, well, we'll get to that. So dad has cash, the son has a traditional IRA, and they're both coming in as 50-50 partners on the deal. So the title reads, the custodian for the benefit of the son's IRA, 50% owner, the father, 50% owner, tenants in common. So disqualified? Yes, they are. However, as long as neither one of them have any ownership interest in the property, and because it's a new deal, they can invest as long as they do so concurrently. It's only after the deal closes that disqualified person rule comes into effect. So it's not like dad can buy it on Tuesday and then son's money comes in on Wednesday. That would be a prohibited transaction. They have to close concurrently. So they could never live there. Their ascendants and descendants can never have any personal use, not even for one day, no personal use. But there you go. So father and son can, or other husband and wife, father and daughter, mother and daughter, whatever, can buy properties together as long as they do it concurrently. After the deal, they could never buy each other out, right, because they're disallowed to each other. Expenses and profits are split pro rata. In this case, it's 50-50. So half of it, say, for example, here comes a rent check. Half of that rent money is going to go to dad's checking account. The other half is going to go to the son's IRA. Same thing with bills. The son's IRA pays half. Dad pays half out of his checking account. And there you go. So with real estate in particular, it's an asset that has expenses. And if you're a real estate investor, which I guess you probably are, you know this. You know this very well. So what if the IRA depletes its reserves? Because all expenses of the IRA have to be paid for by the IRA. So what are you going to do? Number one, you can make your annual contribution. The amount of that contribution depends upon your age, your income, and your account type. So talk to your tax advisor on that one. You could liquidate other assets in the IRA. Maybe your IRA owns this property that's got this huge tax bill that you have to owe, or you have to pay. But maybe you've got some precious metals. So you sell the precious metals and use the proceeds to cover that tax bill. If those things won't work and you still are looking for money to cover the expense, transfer money from another retirement account. Maybe you still have money over in the stock market across the street. So it'll take a couple weeks, but move that money over. You could. You could also bring on a partner as long as they're not disqualified. That's a little tricky, but you could do that. The IRA could actually borrow money. You could probably get a non-recourse loan from an individual if they want to do that with you. And if all else fails, you could just sell the asset. So these are the things you can do if the IRA depletes its reserves and has expenses that it needs to pay. Now, you may have heard of what's called a checkbook IRA, which is the wrong name because it's confusing. What it really is an IRA-owned LLC. So it's not something that automatically comes with your self-directed IRA. It's a tool that your self-directed IRA can use. And there's, you need to pay someone to set it up. A third party needs to set it up. And there are special rules about this special purpose LLC. So a lot of times people have the misconception that their IRA automatically comes with a checkbook, and it does not. But what an IRA-owned LLC is a special purpose LLC that has special language in it for this purpose. Your self-directed IRA buys 100% of the initial shares of that IRA, and then you as the managing member now have checkbook control. You're the managing member of the IRA-owned LLC. You can write the checks. But understand that with great power like this comes great responsibility. You have to follow all the rules, make sure that you're not committing a prohibited transaction, and if you have access to your funds, and say, for example, you use your debit card to put gas in your car from your IRA-owned LLC, that could disallow your entire IRA. So you need to make sure you follow all the rules for IRA investing. Of course, we'll be happy to discuss that with you. If you've got an investment, you say, hey, I'm thinking of doing this in my IRA-owned LLC, we'll be happy to talk to you or refer you to an attorney if you need an attorney opinion letter, for example. And when it comes to self-directing, what can you use to self-direct? It's not just the IRA. We call it self-directed IRAs, but there are a lot of different things. Of course, there's the traditional Roth, SEP, simple, spousal, inherited that we talked about. An IRA is an IRA. You can self-direct all those. Technically, you can also self-direct employer plans, although a lot of them don't let you. Most of them don't for reasons of responsibility and fiduciary duty. But you can have a solo pay. If you're a self-employed person with no employees in any of the companies you own, you qualify to have a 401k for an individual, and you can self-direct it. You can also self-direct something called a Coverdell or ESA, Education Savings Account, and you can self-direct an HSA, a Health Savings Account. So these are the different kinds of accounts that can be self-directed. So how do you do this? I like to say it's as easy as 1, 2, 3. It's not easy, but there are steps, and we guide you through it. Open, fund, invest. Complete an application. We have a $50 setup fee. Give us a copy of your statement, your driver's license. We get your account opened. Usually happens the same day. Step 2 is to fund your account, either by writing a check and making a contribution, doing an IRA to IRA transfer, or rolling over a previous employer's plan. So now your account's open and there's money in it. Now you tell us what you want to invest. You direct your retirement funds into an asset, and we help you out with that. So if you'd like more information, I'd love to talk to you. Maybe you've got a story you want to tell me, or a scenario you've got, a personal situation. Contact me. My email again is kHall@udirectira.com. And with that, I'm going to turn things back over to Veronica, and I'd be happy to take any of your questions. So just let me know what you'd like to know. So let's see. How can I do this? I will change presenter. There we go. Hey, Veronica, thank you so much for letting me be your guest today. I think you should have the control of the screen back.
Okay, great, Karen. Thanks so much. Let's see. Let me get this changed back over. And yes, looks like that's great. Well, in closing, I just wanted to thank Karen Hall for being with us. I really appreciate your wealth of knowledge and your time in helping us get educated today. So in order to take the time to increase your financial and investment literacy, this is really a great investment, number one. And number two, so you may be wondering about how you're going to take the next step. So if you have any questions for Karen, please contact her. And if you would like to sign up for a discovery session with me, that is certainly available. Together we can find out if commercial real estate investment is a good fit for you. During the session, we can discuss your investment goals. I also like to take the time to get to know you a little bit better. And I'll also share additional wealth building strategies and the mindset necessary for you to help live and achieve the life that you've always dreamed about. So in order to schedule that, you simply go to veronicasaldivar.com/discovery to sign up for your session now. There is limited availability over the next 2 weeks, so be sure to sign up right away. But I will be more than happy to discuss your investment strategy into commercial real estate. Again, thanks so much for your time, and I look forward to chatting with you very soon.